Morning, be seated, thank you.
CICS 1 of 2023 of the Commission's own motion, 2023 State Wage Order pursuant to Section 50A of the Industrial Relations Act.
Take appearances, please. Mr. Entrican for the Minister.
Yes, Chief Commissioner, thank you.
Thank you very much. And Dr. Wesley for
Yes.
CCI.
Yes, Chief Commissioner. We've also got Sam Collins as
Mr.
well.
Collins is with you, thank you very much. Dr. Diamond for Unions WA.
That's correct, Chief Commissioner.
And Mr. Hanson for WACOS.
Yes, thank you, Chief Commissioner.
Yes, thank you very much. We have received the written submissions that have been filed by the Section 50 parties and also WACOS, and a written submission from the WA Local Government Association and the replies by the Section 50 parties, which we have read. We've also received a copy of the CCI Business Confidence Survey March quarter 2023, which has also been provided, I believe, to those at the bar table. In accordance with our usual procedure, the order of addresses for today will be firstly the Minister, secondly CCI WA, thirdly Unions WA, followed by WACOS, and of course you'll have a right of reply in the usual way. We understand, Mr. Entrican, that Mr. Christmas is here again today to help us, and he will present at the first stage for you.
Thank you, Chief Commissioner. If it pleases the Commission and Court session, yes, we'll start with our expert witness from the Department of Treasury, and then I'll briefly summarise the Minister's position. If it pleases the Commission, we'll now call Mr. Christmas to the
Thank you
witness
very much.
box.
Yes, Mr. Christmas, please come forward, thank you.
Please state your full name and address.
My name's David Brian Christmas and my address is 28 Barrett Street, Perth.
Do you sincerely declare and affirm that the evidence that you shall give to this Commission shall be the truth, the whole truth, and nothing but the truth?
Yes.
Be seated. Thank you very much, Ms. Christmas.
Thank you.
Mr. Entrican.
Mr. Christmas, can I confirm that you've made a witness statement for these proceedings?
I have.
And is the original one the one that you have in the witness box?
Yes, I have it here. I can demonstrate it.
Very good. And Mr. Christmas, your witness statement states that you and your colleagues at the Department of Treasury have prepared the Economic Outlook document submitted as attachment A to the Minister's primary submission. Is that correct?
Yes.
If it's convenient at this point, Chief Commissioner, I seek to tender the PowerPoint presentation that Mr. Christmas will be
Yes, thank you very much. I think we might tender both the statement and the PowerPoint. The witness statement of Mr. Christmas will be Minister 1, and the PowerPoint presentation dated today's date will be Minister 2. Thank you very much.
Thank you. I'll just distribute some copies of the PowerPoint presentation for the other parties. Thank you, Mr. Christmas. Could you please take us through your presentation?
Yeah. Thank you. Thanks, Chief Commissioner.
Very good morning to you, Mr. Christmas.
So just before I start, I'll just give a brief outline. So the state wage case presentation is based on the 23-24 state budget released on the 11th of May this year. As noted in the budget papers, West Australia's economy, as measured by gross state product, is forecast to grow by 4.25% in 2023. This is the strongest rate of growth since 2013-14, and it's been bolstered by strong contribution from exports, with increases across a range of mining and agricultural commodities. However, GSP growth is expected to moderate to 2.25% in 23-24, and that's consistent with slowing growth in the domestic economy, which has already begun, as household consumption in particular slows in response to high interest rates. The state's labour market was operating at capacity in calendar 2022, with very strong jobs growth, particularly in full-time jobs. The unemployment rate was close to historical lows, and the participation rate reached an all-time high for any Australian state or territory. Labour market conditions remain strong, with annual average employment now at 2.7% in April. The unemployment rate slightly higher than its recent low, and the participation rate has eased from its recent highs. Monthly employment has picked up recently after declining in the second half of 22, and job advertisements have bounced to record levels. Nevertheless, labour market conditions are expected to moderate in line with slower growth in domestic demand. The recent strong labour market conditions are now flowing through to base wages, with the WPI wage price index increasing at its strongest pace since September quarter 2013. That's in annual average terms. Consumer price inflation remains elevated, but appears to have peaked in the December quarter 2022 and is forecast to ease to 3.5% by the June quarter 2024. There are a range of international and domestic risks, which I will refer to at the end of the presentation. So, surging in, elevated inflation and an associated tightening of global monetary policy by central banks. The slowdown in global growth from 22 reflects the lagged impacts of rapid increases in interest rates from over 22 and early 2023. The IMF notes that in early 2023 there were tentative signs that the global economy would stabilise following China's reopening, but there are some additional risks at the moment, including recent stresses in the financial sector. So this chart here really just shows the extent of the rates of inflation globally. So central banks have been increasing policy rates in response to a lift in inflation in calendar 2021 and beyond. And that is expected to slow global growth this year. So monetary policy does have lags. So you raise rates, but it doesn't always flow immediately in terms of impact. So headline inflation has peaked, but as you can see on the left-hand chart there, but interest rates may rise further if there's signs that inflation is being sticky. The key central banks, the Federal Reserve, the European Central Bank and Bank of England, are now indicating they will wait and see what data tells them about the impact of those rates before any further changes, although they emphasise the possibility of further rate rises in inflation should it be stickier than required to achieve their targets. I would note in the US, central bankers, some central bankers offer opinions outside of the official, and they do have expressed different views, so you may see some commentary to that effect.
Federal Reserve seems to do that quite regularly.
Yes, that's right. So China obviously is a key part of our growth, and in fact, our growth is slightly stronger than global growth in terms of our key partners. So our key partners' growth we estimate to be, in 2022, actually a little lower because China was quite weak, but we expect it to be around 3.8% in 2023. Oh, sorry. China accounts for just over 50% of our exports. So what happens in China has a lot of impact here. So growth in China's economy slowed from 8.5% in 2021 to 3% in 2022, primarily due to the impact of COVID lockdowns in major cities. You might have recall Shanghai was subject to a lot of lockdowns, but there was some others as well, and that hindered consumption and industrial activity. And there was weakness in the property sector, where developers have been under financial stress. And that's partly because the government was trying to do a bit of deleveraging. The IMF expects growth in China to increase from 3% in 2022 to 5.2% in 2023, before easing to 4.5% in 2024. And much of the growth this year is expected to occur early in the year as households satisfy pent-up demand that was built up during those lockdowns. And also, I suppose, towards the end of the year and into next year, you're going to have the impact of global interest rates on their key trading partners, so that external demand is probably going to weaken towards the end of the year and into next, which is sort of explains why you have a increase to 5.2 this year and then there's moderation in growth to 4.5. Areas where the Chinese government does have some influence is in the infrastructure investment, and it's putting record amounts or close to record amounts into infrastructure investment. So you can see that that's last year and into this year. So that's caused infrastructure investment to go up. And that accounts for about 30% of Chinese steel demand. The other, about 25 to 35% is in the property sector, and that isn't nearly as strong. As I mentioned before, conditions in the property sector have been weak. And while policymakers are trying to address, I think they, following public criticism, they've been trying to support property developers a little bit. The actual data on whether the sector's recovering is mixed, and so there's a risk to that sector. Commodity prices have been very high recently, since peak in 2021. They did dip after 2021 because of a range of factors. Obviously, COVID pandemic was one of those. However, they've sort of bounced back because of the interruptions to supply from Russia's invasion of Ukraine. Last year, after that, they did sort of ease a bit, and I think that's partly, the Chinese weakness, which impacted on steel prices. And then most recently, they have gone up again since China's moved its zero COVID policy. So they iron ore prices actually fell through the second to a recent low of $79 per tonne in October. But once China reopened, in the sense it removed its zero COVID policy, the prices went up to $133 a tonne in mid-March. So that policy behaviour has really impacted on commodity prices. They've come off a little bit recently because the steel demand in China has probably been a little weaker than anticipated. The index isn't just iron ore, and it has been supported by high and rising lithium prices, a high gold price, and for a while there, high LNG prices. The Aussie dollar has averaged 67.4 cents in the year to date. We looked at that just yesterday and it was still around there. So, but that is down from 72.6%, US cents in 21-22. So there was a little bit of a depreciation against the US dollar. The national, so that's the sort of scene globally where sort of interest rates are tempering growth. China doesn't actually have an inflation issue. It's really just managing.
Lucky them.
Yes, that's right. So they've actually got some firepower if things go wrong, which is a good thing. But they're obviously having challenges like their property market sector. The national economic forecast for Australia are based on the 23-24 budget that was released on the 9th of May, and as is the commentary. So the Australian economy grew by 3.7% in the calendar 2022, and the Commonwealth Treasury is forecasting it to ease to 3.25% in 22-23. The calendar year was supported by very strong household consumption of 6.5% growth, and that was a record. In 2023 growth was continue to be supported by household consumption, given that there was a post-pandemic pickup in services spending. The rate of growth in national consumption won't be as strong as 6.5. It'll be easing from that. So the first half of the year will be stronger.
And presumably slowing in the second half, consistent with other analysis of the state economy.
Yeah, I don't think they've published it, but obviously it would be that level of detail. But yeah, although they may have, I just haven't got that. But yeah, it's a natural assumption that I think would be correct.
Yeah.
The high level of spending has been underpinned by strong employment and highest level of wages growth in a decade, as well as commodity prices, which supported export earnings. In 23-24, growth is expected to slow and moderate in line with a moderation in domestic demand, and it's the same story globally, nationally, and you'll hear it again for WA. Interest rates are slowing demand. And then there's a bit of a pickup in 24-25, and that's really, I suppose, when wages growth lifts, and that's supporting consumption. The Commonwealth budget projects that conditions in the national labour market will gradually soften in line with lower domestic demand. Employment is expected to grow by 2.5% in 22-23 and 1% in 2023-24, supported by strong migration, while the unemployment rate is forecast to increase from 50-year lows of about 3.5% to around 4.25% in the June quarter 2024. The wage price index nationally is expected to lift to 4% in the June quarter 2024. National inflation appears to have peaked, with year-ended growth slowing from 7.8% in the December quarter to 7% in the March quarter 2023. The Commonwealth budget forecasts national inflation to ease further to 6% in the June quarter 23, and 3.25% in the June quarter 2024. And that projected easing reflects a combination of waning in the effects of global price shocks, including energy price shocks stemming from Russia's invasion of Ukraine, as well as a reduction in supply disruptions from the pandemic. It also is being impacted by the Commonwealth's Energy Price Relief Plan, which, in addition to targeted relief for consumers, also has temporary caps on wholesale gas and coal prices, which are particularly relevant for the East Coast and not so much for us. Or not for us at all, not for our consumers anyway. Interest rates. So the Reserve Bank recently raised rates by 0.25% in May. In comments following that rate rise, the Governor noted that looking forward, some further tightening of monetary policy may be required to ensure inflation returns to target in a reasonable time frame. But that will depend upon how the economy and inflation evolve. The Board's not on a preset course. It will pay close attention to developments in the global economy, trends in household spending and the outlook for inflation and the labour market. But he emphasised that the Reserve Bank will do what is necessary to bring inflation back to target. So like other central banks, the message is we'll wait and see, but there is a risk that they may go up further. So that's the global economy and the international economy as a sort of context for the WA economy. This slide shows household and business confidence. Consumer sentiment actually has been quite weak recently. It's been essentially ever since even before the Reserve Bank started raising its rates. You can see that even before May 2022, which is when they did it, confidence was coming down. But you can also see that sort of spike. I think that's in April. So when the Reserve Bank when there's some commentary that the bank might sort of hold, I think everyone may have got a little bit confident, or at least the measured confidence spiked. But now that they raise rates again, obviously there's that confidence has fallen back. So that does suggest the rates are impacting on confidence, but what that means for the real world, I'll get to in the next slide. Business confidence, it's basically been positive, although it's come off its sort of real strong rates since sort of the April 2021. So this sort of slide does show that retail trade volumes have stabilised, but they're stabilised at a very high level. So you can see following the COVID pandemic starting, actually consumers have been, in terms of retail trade spending, spending has jumped, and now it's sort of levelling off, but retail spending is 15.4% above pre-COVID levels. This slide here shows household consumption grew by a very strong 4.7% in calendar 2022, albeit slightly down from even stronger growth in 5.6% in 21-22. So on the left-hand side, you can see that there's been a very high panel of that slide. You can see that there's been very strong spending on purchase of vehicles, clothing and footwear and furnishings, since the pandemic. So that all those items have been quite strong, but some of those items are not going to be repeat purchases. So that's one reason we'd expect consumption to slow, and we can see that household discretionary spending is also falling in terms of the growth rate. So on that right-hand panel, if you exclude travel services, which is basically us, it's largely international and domestic flights, but largely international travel there. So if you exclude that, then our growth, household consumption in the rest of those discretionary items fell from 11.4% growth to in 2021 to 4.3% growth in 2022. So that's a marked slowing. That said, travel services spending has increased because West Australians have a strong desire to travel.
People can now do it.
Yeah, they can now do it. So that's sort of, if you include that, it moderates the level of decline. And transport services is still well below pre-pandemic levels, so it's only partly caught up. And in the December quarter 2022, which is our latest data, they were almost 20% below the December quarter 2019, 18.9%. So it's still got a way to go, is my point. And if you look at it in the calendar year of 2022, it was actually 35% below 2019. So we can see that there's been a slowing in consumption. What I would say is, in aggregate, West Australian households are relatively well placed to traverse the current interest rate pressures. Gross household income in West Australia exceeds household consumption by a significant amount, which is reflected in the high savings rate, which is a few percentage points higher, more than 5 percentage points higher than the national rate. So that suggests that in aggregate, households have the capacity to both continue spending at high levels and continue to save, although their savings would be at a lower rate than previously, especially as they divert larger proportion of their income to interest payments. That said, just to acknowledge that's an aggregate level, and different households will be in different circumstances. So growth in consumption is expected to ease from 5.6% in 21-22 to 3.25% in 22-23, and then to 1.5% in 23-24, basically as consumers cut back on non-essential purchases and reflecting the impact of those mortgage rates. Beyond that, we're expecting household consumption growth will lift for a variety of reasons, but that is, we've got strong, reasonably good population growth, higher wages growth, ongoing employment growth, and house prices, which are sort of a wealth indicator, are also forecast to increase.
And it looks from that that slide that the household consumption patterns are returning more to trend in the year or two ahead, broadly?
Yeah, returning to trend, yes. They'll be a little bit higher on average than the last decade, but then the last decade was quite subdued. But they'll be a bit lower than the historical average. Yep. The housing market has there's a record number of homes under construction at the moment. There's 27,500 in round terms, 27,439 dwellings under construction, but that was at the December quarter 2022. That is our latest ABS data.
Taking a record period of time to construct.
They are, yes. So that's really because there's been delay. Well, initially there was material and labour shortages. Some of those shortages, particularly, because the housing has worked past the first part of the construction cycle now, largely. You don't have so many shortages in the sort of starting trades, but you do have those in the finishing trades. So there still are some shortages in that space, and that's why we've had building times extended to record amounts, really. Interest rates are also impacting on new demand for new construction, as you can see from the chart on the right-hand side. In fact, finance commitments for construction are at their lowest level since records began in 2002, and approvals also in the March quarter. So that's finance commitments for the March quarter. I think they do bounce around from month to month, but that was a quarterly number. And approvals, building approvals also are close to their lowest levels in 40 years. So the interest rates are having an impact as well. Dwelling investment, because of those delays, you've sort of actually had some work shift from we expected it to happen this year, now it's happening next year. And so it's sort of flattening the profile a bit relative to what would otherwise be the case. So we're forecasting dwelling investment to grow by 6.5% next year, and then fall by about 7.75 in 25, 26, reflecting that sort of slower inflow of buildings. And this year, actually, it's a slight. We've got a forecast slight decline, and that's just because of those delays. Business investment, which you can see, we've got a comparison here, really, of investment a little bit prior to and then through the pandemic period till now, and it's been relatively. Well, it's not increased over the period, but it's been relatively stable over the last few quarters, and that is largely there has been constrained somewhat by labour availability and delays in sourcing equipment for some projects, not all projects, but some projects. So that has meant a sort of slightly flatter profile than we'd anticipated. So there's also been a few other issues. One of the big sort of firms that helps construction went into administration, and in some cases costs have meant people are revisiting their investment plans. That said, we are still expecting the investment to grow we're expecting it to grow by 3% this year in 22-23 and 6.7% in 23-24. Essentially, the growth we expect to be supported largely. We've already got Scarborough and Pluto, and work on them is ramping up this year. So in 22-23, that's where we expect some support. And other projects are starting, like Mount Holland Lithium Mine, which is owned by Wesfarmers, I think, and Onslow Iron. And then next year we'll actually continue to have spending on Scarborough Pluto, which is our biggest project by far. Work ramping up on Crux, which is another LNG project. And some additional spending on Onslow Iron and Western Range. So there's a number of projects that are supporting that expected outlook. So overall, on balance, what are we expecting for the state's domestic economy? Well, it's already started to lose momentum. State final demand, which is the measure of the domestic economy, it's already slowing from 5.6% in 21-22 to 3.9% in calendar 2022, and we're forecasting that to ease to 3.25 in financial year 22-23. And again, the large proportion of that easing is in that household spending space that I mentioned. In terms of the external sector, these charts can be a bit challenging, but everything below the line is imports, and everything above the line is exports, and one is goods, exports, and imports, and the others is services, which is that travel. So the state's export performance has been strong in 22-23. We're forecasting 6% growth, but in nominal terms, goods exports reached $272 billion in March 23, so over the year to March 23. So that's a really strong result. And in terms of that 6%, we're expecting that growth in volume terms in 22-23. That comes from increases in iron ore, LNG, lithium, and also wheat and canola have done very well following a good harvest last year. We're expecting goods exports to slow to about 2% in 23-24 and 0.75% by 26-7, and that reflects that operators are going to be operating at close to capacity. Iron ore, there are some gains there, but they're incremental rather than massive jumps that we've seen in the past. Services exports, which is on the right-hand side panel above the line, So that means students and international students studying here and visitors spending on tourism. We're expecting that to rebound and to reach pre-COVID levels, or actually exceed pre-COVID levels in 24-25. And similarly for net, our services imports, so us travelling, West Australians travelling overseas, we're expecting that to reach exceed pre-COVID levels by 24-25. But because we spend more overseas, not just on tourism, but that's a large part of it, than international students and visitors and other businesses spend on services in WA, that will actually help reduce. It's a moderating impact on our GSP growth.
It seems almost, two-speed economy is probably not the right way to describe it, but with slowing domestic demand, but very, very strong external sector with commodities and agriculture has boosted the state's overall economy significantly.
In 22-23,
Yeah.
it has very much so. That's going to come off in future years to sort of a small. There'll still be contributing, but more smaller contributions. Yeah. And then this summarises the whole domestic plus external sector, and we've got GSP is going almost a decade high rates for 9 years. I think we've got there, largely supported by that lift in exports, as you just mentioned, Chief Commissioner. And then growth is expected to ease to 2.25% in 23-24. And again, that reflects a smaller contribution from international trade and household consumption. One thing that has been really strong is net overseas migration. That's really rebound very strongly, as you can see in that left-hand panel. And even net interstate migration has been quite strong, even through the pandemic period. The left-hand chart only goes up to September 22, because that's the latest ABS data, believe it or not. But what we do is to try and track net interstate migrations, which is that light and blue line. We do look at net driver licence transfers, and that's showing that net interstate migration should continue being strong well beyond the September 22 as a lead indicator of what's actually going to happen. And what that means is we've actually got very strong population growth forecast for 22-23, in fact 2% growth in population, and that's really because of that bounce back in migration. I should know about 50% of that, though, is students, international students. And then we have that easing off, as you can see, in terms of what we've got graphed here is growth by percent, but growth by levels, and then that eases off to growth that is equivalent to 1.6% in 2027. In terms of the labour market, after levelling off in 2022, employment has started to lift in recent months, rising to a record of 1.53 people in April. And notwithstanding that, though, employment growth in annual average terms is easing. It's eased to 22.7% in April 2023. What we do have is what we haven't had in the last, ever since the pandemic, is the trough of employment, when the pandemic restrictions were the highest. The bounce back has been very strong in full-time employment, as the left-hand panel there slide shows. More recently, and even recently through the last year, full-time employment increased by 6.3%, which is more than growth in overall employment, and that's because part-time employment in annual average terms has fallen by 4.8%. So it seems to us, it seems at face face value level, I suppose, that there may be some shift in employment from being people upgraded from part-time to full-time, or something of that nature might be going on. But what is definitely happening is you're seeing a lift in full-time in hours worked, because the employment growth has been dominated by full-time employment.
Is that likely to be connected with rising interest rates, do you think?
We are expecting employment to moderate, and yes, you would expect that to be in both, but it'd probably hit both full-time and part-time. It really will depend on firms' decisions about how they want to manage that. One reason they may have moved from people from full-time to part-time is they couldn't actually find we as I mentioned at the starting slide, we almost seem to reach capacity in 2022. So one way you could still increase your labour input was going full-time. So full-time perhaps is a bit more, if things are really strong, you'll have that growing. So in a sense, there is a cyclicality to it. It's an indicator of the strength of the labour market. And if that eases, yes, full-time would probably moderate as well. We're still expecting employment growth, but obviously the pace will moderate, and whether it moderates in the full-time or part-time will really depend on those decisions. In terms of by industry, mining has been the strongest in the last annual average in terms of absolute number of people. So increase of 17,700 people in mining, well, that's about 13.6%, and now it's become the second largest employing industry behind health, and it's the largest full-time employing industry. So that's another reason why that full-time employment was strong, because mining is dominated by full-time workers. And accommodation food services grew by 12.3%, with strong growth in hotels, as well as pubs, taverns and bars. On the other end of the spectrum, it does look like retail trade saw a decline in employment of 14,200 people, or 10%. It's worth noting, though, that that's coming off a very strong high for 144,200 people in the year to May 2022. So prior to that, there was an increase in 23,000 people. So it almost seems like it went up and now it's sort of partly correcting itself. So it's just worth bearing that in mind on the retail trade side. In terms of job vacancies, they did sort of come down a bit in late in the second half of 2022, but now they've been recovering and are at record levels. So 35,200 vacancies in April 2023. So that should, the high level bodes well for future hiring, but it also may just reflect that businesses are finding people hard to find, so they just have unfilled vacancies. Yeah, it could be a combination of those two things.
And with the opening of the borders, with increase in migration, presumably that will start to, the lack of spare capacity will presumably ease.
Yes, we'll get
in the period ahead.
Yes, there are some through industry liaison. There is that observation that people are now starting to find it a little bit easier to fill, get people they need. We're expecting. Employment growth has already started to slow from 5.8% in 21-22 to 2.7%, and we're expecting it to in calendar 2022. So 5.8% in financial year 21-22 to 2.7% in calendar 22. From the financial year 22-23, we're expecting it to fall to 1.75%, and then 1% in 23-24. So that's all in line with that slower domestic growth that I was talking about earlier. One thing that we have observed that's pushed the unemployment rate down to, and it's now sort of stabilised at 3.5% in annual average terms. It did reach a low of 3% in April last year, and it's now 3.6%. But you can see it's basically flattened in terms of that annual average growth. And that fall in unemployment rate has been relatively consistent across other jurisdictions as well. Youth unemployment, that's actually dropped dramatically, as you can see from that chart. So the number of unemployed youth peaked at around 32,000 people in annual average terms in February 21, and has since eased to about 19,000 in March 2023. And I say March because we actually haven't got the breakdown of that detail for April yet, even though we've got aggregate data. So the actual youth unemployment rate has fallen to 8% in the year to April, near the lowest annual average rate in 13 years. Unemployment rate is forecast to average 3.5% this year, and then gradually rise to over the forecast period, although we're expecting it to increase to 4.25 by 24-25 from 4% in 23-24, and then stabilise at around 4.5% after that. Workforce participation, I mentioned before, it actually reached 70.1 last year, and that was sort of a record high for all states and overall at any time in the current series. So it's come off a bit since then. So I think the strong conditions in the labour market of the past 2 years enticed a record number of West Australians into the market. But as things have started to ease in terms of that employment growth levelling off, perhaps people haven't been enticed into the market so much, and in fact some people may have left. So the participation rate has come down a little bit. And obviously participation rate is driven in part by the number of people in the labour force, and that's influenced by growth in population. So we haven't had a fall in employment at all, but the part rate's gone down partly because the population's gone up. What we have seen here is that male participation rate hasn't been as strong as female participation rate in terms of increasing in the period of the pandemic. In level terms, they are different, but not in terms of the sort of that trajectory you can see. In terms of wages, the West Australian Wage Price Index has increased to 3.4%, the strongest annual growth.
Figure we haven't seen for quite a long time.
Yes, that's right. That's right. And obviously that's sort of those tight labour market conditions have started to impact on base wages. While base wages have increased, that's not to say that employers are still using other forms of, like they are still using bonus payments and to attract and retain people. So this is private WPI with bonuses and without bonuses. So the private WPI, including bonuses, in annual average terms, reached 4.6%, which is very, compared to 3.9% without bonuses. So you can see that there's stronger growth once you take bonuses into account. And other data like compensation of employees per employee has increased at a faster pace than wage price index, because that indicator picks up things like people being promoted and the like. The wage price index is sort of, for any given job, what's your wage increase? So the other indicators also, the average weekly earnings in West Australia, which we've only got data till November last year, because it's only half yearly now, but that increased by 5.2% in calendar 22, which compares, well, so that again is higher than that WPI growth of 2.9% in that calendar 22. So just making sure we compare like with like does show that other indicators are showing slightly stronger wage growth is the point I'm making. Just in terms of WPI, the strongest rates of growth have been in construction, and most industries, as you can see here, are growing at faster than 3% up to the March quarter 2023. This next slide, yes, it's more challenging than the Reserve Bank's previous reporting of their industry liaison, but I think but what it does show is current wage and growth expectations based on their industry liaison. So there's a certain proportion that are expecting current wage growth of more than 5%, and just in that very latest period, that number's fallen a little bit. So it was increasing, and then it's just ticked down a little. Those they're expecting, the firms that they talk to, about a little bit more than 60% of those are expecting wages in the 3 to 5% bracket, and most people are offering more than 3%. But what we are seeing here is in a statement of monetary policy, which is where we've taken this chart from. So we've sourced the RBA there. The RBA has noted that national wage growth expectations over the next 12 months have moderated over recent months, and in aggregate are around 3.75%. So factors noted by firms expecting wages growth to slow are softening business conditions, internal focus on cost control, lower voluntary turnover and improved labour availability. Now, and SEEK's, so to complement that, SEEK's advertised salaries, you can see that those rose to above 5%. Growth in the advertised salaries index rose to over 5%, but now that's starting just to come off a little bit. So our own forecast is there has been this growth momentum, and there's reasons why you'd expect it to carry on a little bit. So we've got growth increasing to 3.75 in 22-23 from 3.4 now, and then to 4% in 23-24. But as you can see, there's already those sort of leading indicators suggesting it might just be tempered from then on. So
tapering off a bit, perhaps.
Yeah. So we've got growth now of 3.75 in 24-5, and then it just sort of tempers off, but it's still expected to remain well above rather than the last decade, and not too different from the historical average by the end of the period. In terms of inflation, press headline CPI appears to have peaked in the December quarter 2022, and growth has fallen to 5.8% in the March quarter 23. That was the lowest growth of any state or territory, and compares with a national inflation rate of 7%. Excluding the Perth's headline CPI grew by 0.9% in the March quarter, and that's the headline rate, and excluding the electricity sub-index, it increased by 0.8 in the March quarter. So key contributors to the growth in the March quarter were food, non-alcoholic beverages, education and housing and health. In year-ended terms, which is that sort of inflation rate that everyone's familiar with, so March quarter on March quarter 2022, the main contributors were food and non-alcoholic beverages, up 1.27%, recreation and culture, 0.82 percentage points, furnishing and household equipment, 0.6%, and new dwelling purchases, 0.7%. So those were the sort of rates of increase underpinning that sort of 5.8% growth. So Perth CPI, excluding the electricity sub-index, is forecast to grow by 5.75% in year-ended terms in the June quarter, with growth easing to 3.5% by June quarter 2024. So what's that based on? Well, the expectation is based on a further moderation in inflation as a result of improved global supply chains. So we've got a chart on that left-hand panel which shows that there's an apparent leading relationship between the Federal Reserve's global supply chain pressure measure and the CPI growth in West Australia. So it takes a few quarters for that sort of decline in global supply chain pressures to actually show up in our CPI, but that's one of the reasons you can see that's quite a good relationship there in the left-hand panel. And freight costs have come down as well. You can see that that's come down from, I think we have 80% lower now since January 2022. So that's the shipping container cost from China, which is that would be the blue shaded one. A moderation in consumer demand in response to higher interest rates and inflation. The price of new housing is easing, so the rate of producer price inflation for new houses has eased from 6.4% per quarter in the first half of 2022 to 1.1% per quarter in the last 3 quarters. So the cost of constructing homes has come off considerably. We're also a normalisation in travel prices. So I think I just mentioned that in year-ended terms, recreation and culture contributed 0.8 percentage points in the year to March. Well, that reflects very high airline prices as much as anything. Yeah, that's a big contributor to that. So as there's a normalisation in travel prices, as airlines bring on capacity, you can have a fall in that as well. So it's for those reasons we're expecting inflation to ease, with our view that growth in the Perth CPI will ease to 3.5% in 23-24 after being 5.5% in 22-23. And our forecasts are broadly in line with the national CPI forecast by the Commonwealth Treasury and the Reserve Bank. It's the latest statement of monetary policy, both of which have been published in May this year, so they're both very recent estimates. The slightly higher national CPI this year would probably reflect those energy costs being a bit higher over on the East Coast, and then the Commonwealth Treasury is expecting slightly lower inflation nationally than us, and that's probably reflecting the impact. Well, that includes the impact of their the energy relief package that I mentioned earlier, which will have a bigger impact over east than here because it's capping gas and coal price wholesale prices. So just to summarise, really, current conditions in West Australian economy are strong. Growth is expected to slow, as due to elevated inflation, high interest rates, particularly on household spend. Conditions in the labour market are expected to moderate in line with the slowing in the domestic economy. And while inflation has been elevated, it is expected to ease to 3.5% by the June quarter. Risk to the outlook, I'll just end with this slide. Central banks have been tightening monetary policy, and there are always lags, and they've got a very tricky task of trying to balance maintaining as strong growth as possible while still achieving their targets. And sometimes they make calls that mean they tighten too aggressively, in which case you might have slower growth than we currently forecast, or the IMF forecasting. There have been some recent instability in global financial sector, so you'll probably be aware of the closure of Silicon Valley because of a run on its deposits in March, and then more recently there's been Credit Suisse has had some liquidity issues. It was bought out by its competitor Union Bank of Switzerland, and so to date they seem to be managed well, but even in May we had the First Republic Bank in the US collapse. So it just depends on how many more collapses there may or may not be, and how well those are contained.
Collapse and confidence.
Yeah, so that's a risk that's sort of come out of that tightening of monetary policy that wasn't evident really until this year. How the Russian invasion of Ukraine plays out could also impact on lots of things, including commodity prices. The impact of higher rates for borrowers, especially those with expiring fixed rate mortgages, and the extent to which labour shortages and supply constraints delay or extend build times. Would be, that's not the complete list, but those are some of the lists that we think are important and worth highlighting. So that really concludes my presentation.
Thank you very much, Mr. Christmas. Are there any questions from those at the bar table? Dr. Wesley, do you have any questions?
Yes, I do. Thank you, Chief Commissioner. My first question, Mr. Christmas, is in relation to the forecast growth in household consumption and the fact that that is expected to slow. Is it fair to say that because of the impact of higher interest rates, that slowing of growth will be seen in the retail trade sector as well?
Well, I think you can already see that in terms of level terms, it's already, in volume terms rather, it's already levelled off. So it's flattened basically. So there is an impact on retail.
And we'll expect to see that same impact going forward over the next coming year?
It'll continue to be impacted by rates. Yep.
Okay.
Again, it depends on, as I noted, really, it'll depend on in aggregate household choices.
Yeah. Okay, thank you. The other question I have is in relation to the growth in business investment, and we can see that that's expected to pick up, and it's particularly dominated by the resource sector, but to a lesser extent, the ag sector as well. I'm keen to look at the other sectors that make up our economy. Is there any expectations, particularly whether there's some that are particularly weak or...
Probably non-mining would be expecting to be a bit weaker in the next year or 2 years, and that's largely based on, I don't have the exact numbers with me, but largely based on expectation survey that was done earlier in the year, and So that's why we would expect a little bit softer in those for smaller investments. Yeah.
Okay. The last question I have is in relation to the construction of these dwellings. So I believe there was 27,500 under construction currently. And is it 2024-25 that we expect those to come online?
Well, we're actually expecting them to start coming online in the 23-24. That's where our dwelling investment number, I'm just going back to dwelling investment here. You can see a bit of a pickup there in the column 23-24. So we're already expecting, we're hearing that companies are getting closer to that stage of completions. In fact, I think one of our biggest builders is basically deciding just to focus on completions. So that should assist with the completion rate.
And I know in the state budget there was an announcement around a visa skills migration program. Are they already built in the assumptions, or do we expect housing construction to actually speed up over the next year or so?
Well, our assumptions basically reflect our view of how it's going to play out. Yeah.
Okay. Thank you. That's all, Chief Commissioner.
Thank you very much, Dr. Leslie. Dr. Diamond.
Thank you very much, Chief Commissioner. I'd just like to ask Mr. Christmas, on the handout, pages 6 and 7. So page 6, we've got the commodity price index. Commodity prices most relevant to the state's economy remain high. We also have on page number 7 the exchange rate, which has the average year to date for the Australian dollar at 67 US cents, which is obviously looks on the chart at least looks somewhat lower than what it's been going back in time. So to what extent so normally you would expect exports sort of demand for the dollar increase, the value of the dollar increases. To what extent is the current value of the Australian dollar due to movements in the US dollar?
The strength the US dollar obviously has a larger impact. I mean, one of the key drivers is just relative interest rates here relative to overseas. It's not just commodity prices. There's a mix of factors that impact it. But obviously one factor that can dominate in terms of all exchange rates relative to the US is the US is often seen as a safe haven when things are challenging, which can mean that the demand for US dollars goes up and therefore other currencies weaken against it.
So to the extent that produces, if you like, a lower value for the Australian dollar, does that impact on the consumer prices for our imports and things like that? Make them higher than they might otherwise be?
The import prices would be higher because of the depreciation.
Mm-hmm. And so to the extent that our source of inflation is imported to some extent, that would be also reflected in the chart, which I'll try to flick to. I forget the page number, if you'll please bear with me. Yes, on page 43, where you've got that chart of the Perth CPI and global supply chain pressure.
Yep. So the question is
to what extent you would say that inflation in Australia is being imported?
Well, while we've had the exchange rate has depreciated, you've also got costs of production overseas coming off. So for a while there, particularly straight after the invasion of Ukraine, energy prices were very high. Those have come off overseas. So production costs overseas are a big issue. And then transport costs, which is the right-hand panel, you can see those have come off a lot. So the extent of import inflation is a balance of all those factors.
Mm-hmm. So to the extent that sort of when people are purchasing goods, be they essential or non-essential, they kind of have to cop or essentially take the price that's determined by sort of global factors.
For globally traded goods, yes.
Okay. Just looking at, just going in fact to your economic outlook statement, and obviously in your presentation you've talked about the expected sort of moderation of state final demand. I think it's 5.6 to 3.25 to 3% sort of going forward. And you've said that primarily reflects a significant easing in household spending, which has already begun. Now, does that projection represent Treasury's forecast of a soft landing for the economy, as opposed to the putative harder landing that might be a recession?
Well, what it reflects is our central forecast, a forecast based on all the available information that we think is most reasonable.
Mm-hmm. So to the extent that you're expecting a reduction in household spending, is that desirable from the point of view of Treasury's forecasts?
Well, forecasts are just... we just generate those from the way we think things are going. Our job is just to look at how we anticipate things will go. A good forecast is an accurate one, but we all from time to time don't get those. But that's slightly different from your question.
But the state final demand growth, as I say, just quoting from you here, primarily reflects a significant easing in household spending. Mm. So to the extent that household spending could be maintained going forward, that would be that would reduce the risk of an inflation in the forward estimates.
Well, I mean, everything held equal, that's a very big assumption. You know, the higher demand for a fixed supply would increase price, but not everything is being held equal. We've given you the best assessment we've got on the basis of the available information.
But you are forecasting that reduction in household spending.
Yep.
Okay. But you've also got an elevated household saving rate.
We
still,
do.
I think, in one of your sections.
Yep.
So the more recent, yours is for 21-22. I think that's the most recent.
That's correct.
Figure.
Yep, yep.
So the most recent information on the household saving ratio, as the ABS puts it, nationally puts it much lower than that for December. Mm. I mean, does that indicate that sort of household savings are being run down somewhat further than what you're...
Well, the national data, I think, is still positive, right? So that means there's still net saving happening. So in general, households are still actually saving. And in terms of our own household spending, if you, I've got my colleague to, so that data goes up to the June quarter, as you mentioned, but if you go up to look at this compensation of employees data and household consumption data.
Sorry, are we looking at your?
No, I'm just giving you this.
Yeah.
But I don't have a chart of this. But let's just go back to this. So extending beyond this savings ratio. We're developing something internally to try and do that. The ABS doesn't actually publish it. But just to give you an indication of compensation of employees, which is a fair proportion of household disposable income. It's not all of it. There is income from rent and other areas, right? But in the last 2 quarters, so stretching beyond there, compensation of employees amounted to $70 billion. Household consumption in the second half of last year amounted to 60, almost 66. So there's a difference there, and that's still, you could argue, well, household compensation of employees includes 10% for your super, yes, but what I'm telling you is that there's other income sources as well. So our income appears to still be in excess of our consumption at the moment, beyond there, which implies that there's still saving happening in aggregate.
In aggregate, so you don't have data that sort of determines what how different income levels will be responding to that situation.
We don't actually. Well, I don't have data on consumption patterns at income level that. Well, we don't have that sort of data that we've got immediately to hand. Let's put it that way. Doesn't mean it doesn't exist with special requests and all that stuff, but yeah.
And I'll finish after this question. But the impact of you mentioned in one of your risks to outlook on the final page.
Yep.
The impact of higher rates for borrowers, especially those with expiring fixed-rate mortgages.
Sorry, Dr. Diamond, could you just turn your microphone towards you? Thank you.
All right,
Thank
I
you
do
very
beg
much.
your pardon, Chief Commissioner.
Thank you very much.
Hopefully that's better.
I've just been advised that's very helpful.
Thank you. Sorry, I'll just find my place. So I believe also in your economic outlook, the impact of higher rates, you also mentioned the impact of higher rates for borrowers. That is expected to have an impact on higher consumption. It's meant to, people ideally, if interest rates are doing what they're expected to do, you would expect sort of household consumption patterns to shift, all right? But we are nevertheless looking at a situation where people this may impact people's non-discretionary spending.
Well, yeah, it certainly may impact on non-discretionary spending for some households. Beyond that, it would be each household's decision on how they want to spend their money. Yeah, but there will be some households that are challenged by these rate rises, and our forecasts are aggregate level though.
And will increases in personal incomes or personal incomes as translated into household incomes allow more space for, I think it's durable goods and non-essential purchases in the retail sector?
Sorry, can you repeat that?
So would increases in incomes, so I'll call it incomes to be neutrally, but household incomes, call it, allow more space even under an interest rate, even in a situation of higher interest rates, that would allow more space in household consumption for durable goods and non-essential purposes.
Yep. I mean, I think it was, yeah. No, it certainly would. One thing I would note is some of those durables we've already spent a lot on, and how many repeat sales we're going to have is another question.
But it would conceivably have an impact on the retail trade that you meant that
potentially
was part of that.
Yeah.
Okay. Thank you very much. No further questions.
Thank you very much, Dr. Diamond. Now, Mr Hanson, do you have any questions?
Yes, thank you, Chief Commissioner. Just in relation to those household consumption graphs, I note that while the decline for non-discretionary annual average growth is not quite as substantial as the discretionary, should we understand that to indicate that households are cutting back spending on items that would be considered essential, such as food, energy and
If we go back to one of these charts here, and again, this is an aggregate story, right? That chart there, you can see non-discretionary household consumption up till at least December 22 was still growing, and it's been steadier in terms of it obviously got hit by the COVID pandemic, but when you take out the COVID pandemic, the sort of peak period, you can see that it's running at 2.5%, 3%.
Okay, thank you.
I'm only taking that as I don't have the number right in front of me, but just for the graph.
And just in relation to that forecast moderation in Perth CPI growth, are you expecting to observe that across the different CPI expenditure categories, including non-discretionary items, or will that largely be driven by the significant declines expected in those areas you highlighted, such as dwelling construction?
Sorry, can you just...
Yeah, sure. So that the moderation in the Perth CPI, are you expecting to observe that across different expenditure categories?
Yes.
Okay.
Yeah.
Thank you. That's all the questions from me.
Thank you very much, Mr Hanson. Did anything arise, Mr Entrigan, from those questions?
Nothing specific, Chief Commissioner. Just confirming for the benefit of the panel, Mr Christmas, Treasury does only forecasts. They don't set monetary policy as such, so there isn't necessarily targets for things like household consumption and inflation and all those things. That would be a fair statement to say that.
All our forecasts are aggregate.
Aggregates, yes.
Thank you very much.
Thank you very much.
Mr Christmas, you've got a really helpful slide at page 47 where you set out the major economic aggregates.
Mm-hmm.
What I'm wondering is whether you're able to tell us at a really high level how that compares to last year. I appreciate we've got the granular detail last year and this year, but at a really high level, are you able to say what's different this year?
Yeah, I brought my last year's budget with me, to be honest, which I haven't done. So, but look, I think in terms of the gross state product, that's a very strong result for this year. But I think in terms of the outlook, we would say that's probably. Certainly consumption is our forecast, I think, would have been revised well down. Compared to last year, we actually didn't expect export, so gross state, the external sector to be as strong. And we are very surprised by the actual result in 21-22 when it was quite, exports were either weak or even maybe negative slightly, which sort of really surprised us. So because it's coming off a lower base than we thought, the external sector's making a much bigger contribution. So that's one area I can tell you unequivocally that this year we weren't expecting last year the exports to make that contribution. And obviously, in light of where the economy has gone, interest rate rises and the like, we've certainly, that household's consumption is softer than we thought. Conditions are really quite tight in the labour market. I think they were pretty tight last year. And we did have a question on wage growth and whether it would increase last year, and everyone was worried that we were forecasting it to increase and whether there was a risk it wouldn't. Well,
It did.
It did, which is great. But whether, the 4% are pretty, good. 23, 24 is a pretty strong rate of wage growth, and whether we, again, I don't have the number from last year in front of me, but whether we had it quite as strong as 4% is something I don't think we would have. And the unemployment rate has reached, historic lows. So whether we reached 3.5%, I don't think we probably did. But again, without giving you my sort of
Yes.
recollections, I suppose, or best judgment.
Thank you, Mr. Christmas.
Anything arise from that question at the bar table? No, all right. Thank you very much. Mr.
Sorry,
Christmas.
Chief Commissioner, can I answer one question?
Yes, of course.
Yeah.
Yes.
Just in addition to your question about investment outside of mining. Well, we call it minor investment, and we do have a small decrease this year in 22, 23, and 23, 24. But you're talking modest declines. I think next year it's in less than even 2.5% decline. There is a decline, but not major. Yeah. So I just wanted to.
No, thank you
clear
for that
up.
clarification.
Yep. Thank you.
Well, thank you very much for your efforts again, Mr. Christmas. Your presentations are always a great help to us, and we do appreciate the time and effort you put in. So thank you very much.
Thanks, Chief Commissioner, Senior Commissioner, Commissioners.
Now, Mr. Inchkin.
Thank you, Chief Commissioner, and thank you to Mr. Christmas and his team at the Department of Treasury. We note that Treasury has undertaken a significant amount of work to assist with today's proceedings, and that's coming straight off the back of a fairly intense few months preparing for the state budget, and we've both become familiar with some of our contract cleaners of late in the evening. So we do sincerely appreciate, and the Minister extends his sincere appreciation for your time today. If it pleases the Commission and Court session, I'll now move on to the Minister's position. The Minister recognises the importance of having a strong and meaningful safety net for workers covered by the state industrial relations system. The state wage case process plays a critical role in protecting the needs of the low paid and ensuring fair wage standards are provided for in a dynamic and rapidly evolving economy. The Minister notes the Commission awarded an increase of $40.90 to the state minimum wage in last year's proceedings, lifting it to $819.90 per week. It also increased state award wages below $887.40 per week by $40.90, and it increased award wages of $887.40 and above by 4.65%. This was broadly in line with the decision of the Fair Work Commission in the National Annual Wage Review. The West Australian Government welcomed this decision at the time, as it assisted many low-paid workers to keep up with the cost of living during a period of rising inflation and interest rates. While there has been a number of economic challenges over the past year, the Minister notes the West Australian economy has continued to display considerable resilience, with low levels of unemployment, labour shortages in a range of industries, and strong full-time employment growth. Many of those statistics were demonstrated in Mr. Christmas's presentation. As demonstrated in much of the data presented this morning, most economic and labour market industries are now well above pre-pandemic levels, and the state's economy has remained buoyant. However, the domestic economy is expected to slow in the next financial year, primarily due to an easing in household spending as consumers pull back on, in particular, non-essential purchases. The Minister acknowledges that inflation has been elevated over the past 12 months, particularly in relation to certain non-discretionary items such as food and housing. To control inflation, the Reserve Bank has been increasing interest rates, and we saw that there had been 11 interest rate increases in the last 12 months. Although necessary to control inflation, higher interest rates do put further pressure on households and businesses in the short term. And the official cash rate is now raised from 0.1% to 3.85% in the last 12 months. All of the evidence suggests that inflation has now peaked and it is beginning to decline. However, it will take some time for inflation to return to the Reserve Bank's target range, that 2 to 3% target range. Perth's annual year-ended rate of inflation reduced from 8.3% to 5.8% in the March quarter of 2003. And that was off the back of a quarterly increase of 0.9%. That's headline inflation. While the recent easing of inflation is welcome, the Minister understands that many West Australian households are experiencing cost of living pressures and have been forced to make difficult spending decisions. The Minister notes that elevated inflation is also an impost for many businesses, particularly small and family businesses where higher input costs can affect profit margins and create additional cash flow challenges. The state and federal budgets contained a range of initiatives to help ease cost of living pressures. In the state budget, this included a $400 electricity credit for all West Australian households, a $650 power bill credit for small businesses, and a range of other support measures for those most in need. The Minister acknowledges these initiatives are a vitally important part of the recent state and federal budgets and are designed to alleviate cost of living pressures and assist the low paid. However, though very important government initiatives, they can't be seen as a substitute for regular and fair increases to minimum and award wages, which still remain a critical element of the wage setting framework. With regard to wages, the Minister notes that wages growth has started to pick up recently, with the wage price index displaying the strongest rate of growth for a decade. Other measures of wages growth have similarly increased in recent months, and we saw a few of those in Mr Christmas's demonstration this morning. Encouragingly, the recent state budget projects real wages will begin growing again from 2023-24, providing some welcome relief to many low-paid workers. By granting a fair and meaningful wage increase, the Commission can assist low-paid workers in the state system, helping to ensure their needs are adequately safeguarded. This is particularly relevant for workers who are more likely to be engaged on minimum and award rates of pay in the state system, in particular female employees, young workers, students and those employed casually. The Minister notes the most recent seasonally adjusted estimate of average weekly ordinary time earnings in Western Australia is $1,988.50, or approximately $103,700 per annum. That's quite possibly the first time it's ticked over $100,000 per annum. By contrast, full-time median earnings in Western Australia were $1,690.65 per week in August 2022. That's the last available data for median earnings, and that's approximately $88,200 per annum. At the same time, the state minimum wage is currently a little under $42,800 per annum, and the C10 classification, that is the skilled tradesperson's classification, is a little over $48,400 per annum. As also outlined in the Minister's primary submission, the most recent data indicates that award-reliant employees in Western Australia have much lower average earnings than those employed on collective agreements and individual arrangements. To illustrate just a few examples of some of these earnings, the base rate of pay for a full-time or part-time wait person under the Restaurant, Tea Room and Catering Workers Award is $22.82 per hour. The base rate of pay for a full-time or part-time shop assistant working under the Shop and Warehouse Award is $23.35 per hour. And the base rate of pay for a full-time or part-time cleaner under the Contract Cleaners Award is $22.74 per hour. And even the base rate of pay for an entry-level childcare worker with tertiary qualifications is only $24.44 per hour under the Children's Services Private Award. Now, no doubt some of these workers will be entitled to various penalty rates and allowances on top of that, and that will take their take-home pay to a higher level. However, others won't. So minimum award wage earners are one of the most vulnerable cohorts of workers and often have little in reserve to meet unexpected expenses for emergencies. It's therefore appropriate their wages be adjusted as part of this year's state wage case proceedings. The Minister contends that doing so will help to satisfy the objectives prescribed in Section 50A of the Industrial Relations Act, particularly those concerning fairness and equity. The Minister submits that any increase awarded in this year's state wage case proceedings should take effect from the first pay period on or after 1 July 2023, in line with normal conventions. Just on the level of apprenticeships and traineeships, the Minister's written submission includes detail on apprenticeship and traineeship commencements and also numbers in training. The information and analysis regarding training arrangements in Western Australia has been provided by the Department of Training and Workforce Development, and the Minister thanks the Department for providing that information. As outlined in the Minister's submission, apprenticeship and traineeship commencements continue to increase in 2022, something that will yield significant benefits for Western Australia in the coming years. Traineeship commencements increased by over 1,300 persons in calendar 2022, while apprenticeship commencements increased marginally for the 6th year in a row. That was coming off a very big increase in 2021. The increased uptake of training opportunities complements a variety of financial incentives and support payments made available to employers and employees to upskill the state's workforce, including a number of fee-free and subsidised courses that have been made available in a range of priority areas. Encouragingly, the total number of West Australians presently engaged in training also increased by 3,750 persons in 2022, and the Minister is pleased to note there's been increases in a range of skilled trades, including automotive, electrical, building and construction, and also community services, health and education. With skills shortages still evident in a wide range of sectors, it's particularly important that training wages continue to be adjusted as part of the state wage order to facilitate the take-up of vocational education and training opportunities in Western Australia. An updated schedule of registered training packages and industry skill levels was appended to the Minister's primary submission for use in this year's state wage order. That was attachment C of the Minister's submission.
Thank you.
I'll just touch on the work value principles, if it pleases the Commission. This was another issue that is relevant to this year's state wage case proceedings. The Minister notes that Unions WA is seeking some amendments to Principle 7, that's the work value change principle, as part of this year's state wage order. The Minister outlined the key changes being sought by Unions WA in the Minister's submission and reply, so I won't repeat all of those here. The Minister recognises that modernisation of the Statement of Principles to reflect contemporary standards would be beneficial and appreciates Unions WA's efforts in drafting this proposal for the Commission's consideration. It's noted, however, that the Statement of Principles exists within a very different legislative and industrial context to the statutory parameters governing work value assessments under the Fair Work Act. Indeed, the National Wage Decision, the Annual Wage Review, doesn't have a Statement of Principles, and various things that would be in a Statement of Principles are built into the Fair Work Act. And given the tight timeframes involved in the state wage case, the Minister hasn't been able to fully assess the effects of Unions WA's proposed amendments to Principle 7, in particular potential cost implications for the public sector. However, the Minister sees utility in engaging in further discussions with Unions WA on this issue and supports further discussions with the Section 50 parties regarding Principle 7 as well. In conclusion, the annual state wage order plays a critical role in maintaining a strong and sustainable safety net of wages and conditions for West Australian workers. Over the past 12 months, Western Australia has largely enjoyed buoyant economic conditions, notwithstanding the challenges associated with elevated levels of inflation and higher interest rates. The Minister notes that our economy faces some headwinds in the months ahead, particularly as consumer spending slows in response to interest rates. Indeed, this is already occurring. The Minister supports the Commission awarding a fair and meaningful increase to minimum and award wages, having considered all of the social, economic and industrial relations objectives prescribed in Section 50A. The Minister submits the decision of the Fair Work Commission in the annual wage review will be a relevant consideration in this year's state wage case and looks forward to making further contributions in due course. The Minister has no further substantive information for these proceedings but reserves the right to respond to matters raised in the presentations of the other parties. If it pleases the Commission and Court session, this concludes the Minister's submission.
Thank you, Mr. Andrews. Before you retain your seat, just one matter I wanted to raise with you. Page 26 of the Minister's initial submission,
Yes.
There's the table which is usually included, which is the gross operating surplus plus gross mixed income,
Correct.
or GOS plus GMI for short.
Yes.
The table refers, unfortunately this is historic data, which refers to 2021 and 22. I note that whilst overall there's aggregate, it's a proxy, of course, as we know. It's not data on individual firm profitability or performance.
Correct.
But the total all industries growth figure, as you've cited in the Minister's submission, is 8.8% over the 2021-22 period. Just looking at the subcategories in that particular table, as you've noted in the submission, agriculture, forestry and fishing is very strong.
Indeed.
I'm looking at retail, trade and accommodation services, and I note particularly accommodation and food services is minus 17.4%, and retail is minus 3.9%. Overall services are minus 21.8%. I compared that to the table produced last year in last year's state wage case, which is cited by the Commission and Court session at paragraph 76 of the reasons for decision. And in that particular table, retail trade showed a positive increase of 27.7%, and accommodation and food services a positive result of 8.9%. Perhaps you might want to take it on notice and those at the VAR table as well, but certainly for myself I'll be interested in any comments that the parties may wish to make about those figures and what significance we ought to attach to them, accepting of course there are limitations with them. A, they are old, and B, they are not actual profit figures, but they're simply a proxy as to some idea of how industries might be going at any particular point in time.
Correct, yes. And I'm certainly very happy to take that on notice and provide any information that we can gather on those figures.
That would be very helpful. Thank you very much.
Thanks, Chief Commissioner.
Thank you. Now, Dr. Wesley.
Thank you, Chief Commissioner. So CCI WA relies primarily on our two written submissions, but we'll take the opportunity today to make some comments. If it pleases the Commission, I'll first make some introductory remarks about our position and then go into some of the areas in more detail. From the outset, I just want to make note of the economic insights that we refer to in both our submissions and in my contribution today. We run surveys in-house. The first is called the Business Confidence Survey, and we regard that as the most comprehensive economic survey of business conditions that WA has. It runs across business sectors and also all sizes of the economy, in all sizes of businesses, but the focus is particularly on SMEs. We ask questions about levels of confidence in terms of profitability, as well as the key factors that are affecting business at the moment. The other survey that we do is a consumer confidence survey, which provides us with valuable insights into consumer sentiment. So we ask questions about spending habits, employment prospects, financial health as well. So in terms of our submission and the figures that we refer to, they're from our March quarter survey results. I want to note specifically that 85% of our respondents were SMEs. So this is the picture that we capture is really very much from the SMEs perspective as opposed to large corporates. So my initial assessment is this year's state wage case is taking place in some very uncertain economic times. And for the first time, we can actually say that COVID-19 is not one of the primary drivers of this economic uncertainty. We're seeing households, businesses and the community at large really learning to live successfully with COVID-19, and we're not seeing that level of social disruption to workplaces and workforces that we saw over the past 3 years. Of significance to the WA economy, and indeed that across global economies, was China's zero policy, COVID zero policy. Unfortunately, that was lifted late last year, but that certainly in the initial stages had an impact on business and consumer confidence, and it certainly had an impact on price pressure across supply chains. And so high inflation is obviously now a critical threat facing all economies, including Australia. And as I said, this could initially be attributed to those initial supply chain challenges, but it's certainly not the only driver. We've got persistent community demand or household demand, as well as Russia's invasion of Ukraine obviously having an impact on energy and food sources. So central banks around the world, including Australia, have responded with this aggressive monetary approach to raising interest rates to limit inflation. The RBA's main objective is obviously to keep it within that target band of 2 to 3% by sufficiently slowing the economy, in part through a reduction in consumer spending. Now, we understand that households are facing significant financial pressure, not least the result of 11 straight interest rate rises, but also everyday items, food, electricity, fuel have become more expensive. And we recognise obviously that the shortage of housing is also putting pressure on dwellings in terms of rents and also established homes. But what the latest consumer price index does show is that while prices are more expensive, Perth is still the most affordable place to live based on that measure alone. As Mr. Christmas noted, WA sits in a very robust economic position at the moment, but economic contraction is forecast. And for us, one of our chief concerns is this economic or potential economic contraction at the same time that these businesses also face a potentially substantial increase to the state's minimum wage. And we say that we know that businesses now are faced with increased cost pressures and cash flow challenges, and a substantial increase to the state's minimum wage will make that situation even worse. We therefore suggest that this Commission in court session is in an unenviable position, noting the need to balance those cost of living pressures on households with the cost of doing business pressures that SMEs in particular are facing. So for these reasons, we request the Commission to take a more conservative and cautious approach, and particularly take in note the announcements by the state and federal government that were designed to address cost of living pressures in making its determination. In line with last year's approach, CCI WA has chosen not to specify a particular percentage increase. We support an unspecified flat dollar increase. And there's a number of reasons for this, and I'll go into it further in my presentation, but this, in essence, is of the recognition that there is a considerable amount of uncertainty that exists, and also the need to support the lowest end of the spectrum, because they are disproportionately impacted by these cost of living pressures. Chief Commissioner, Senior Commissioners, Commissioners, this concludes my introductory remarks. I'll just go into some of these areas in a little bit more detail. So in terms of the state of the economy, as Mr Christmas noted, WA is in a robust and a strong and robust economic position, with growth forecast to be 4.25% for the 22-23. Now, this has been driven by two principal factors: strong household consumption, driven from large saving buffers, as well as record levels of employment, and a rebound in business investment. And as we noted from Mr Christmas, this is largely due to activities in the resource sector, but also the ag sector as well. I just want to emphasise two main points here. The first is the effect of having a strong jobs market. This market at the moment provides people with lots of opportunity and employment choice. And we've seen more of our community participating in the economy. Our unemployment rate remains low, and we obviously have a high participation rate as well. We've also had a number of new jobs created. Businesses have also been given supports to take on apprentices and trainees, and we've obviously seen that reflected in the numbers. And there's numerous opportunities to retrain and reskill in in-demand and higher paying roles. And these measures are all important as they provide the community with employment choice and the opportunity to seek higher paying roles. The second area I want to touch on is economic growth. We just want to emphasise that the state of the WA economy as a whole is made up of a number of different industry sectors. And I think this is the most critical point, is that not all industry sectors contribute equally. And we can see that in comparing the mining industry's contribution to gross state product compared to the next highest sector, which is the construction sector. So the mining industry's contribution is 186.6 billion, compared to the next highest sector is 21.1 billion. So as we can see, our state's current robustness and economic position is really largely dependent on the back of the success that the mining industry has had. And the key point is that economic prosperity is not necessarily shared across other industry sectors, particularly for the SMEs, the mums and dad family businesses. So the Minister made the key point in his submission in relation to this issue, and he noted that performance of the mining industry can skew the perception that WA businesses may be experiencing profit booms when that's simply not the case. We've heard references to the current market as a current high cost, high demand environment as a profitless boom, particularly for mum and dad businesses. So we only need to have a look at the construction sector as a case in point for that. Despite the construction sector being the second highest industry sector in terms of our contribution to gross state product, we've had 211 businesses become insolvent in the last 24 months. Another example is Australia's largest brick manufacturer, Brickworks, was forced to close its latest manufacturing centre in the state as higher costs, cost of borrowing and labour costs have made operations in WA uneconomic. In the Minister's submission, there was some reference to some data, RBA data, about how to understand business conditions. How to understand business conditions in WA, and there was a bit of an understanding or recognition that the data provided doesn't really tell the true picture of business confidence or conditions or otherwise. And we suggest CCI's profitability index is a more suitable proxy to understand profitability of businesses and business confidence and operating conditions. And this index is derived from our business confidence surveys, and it's a business's determination of their change in profit levels relative to the previous quarter. So in our latest quarter results, we found that profitability index was 20% lower for this March quarter than the high that it reached in the December quarter 2020. And so what this suggests is that despite those strong headline figures, businesses are, particularly the SMEs, are under heightened pressure and strain from escalating costs, including labour costs, which has impacted their profit margins. And we only really have to look at ASIC's insolvency data to really support that argument. The latest data for April finds there's been a 58% increase in the number of insolvencies so far this financial year, and that's compared to the same time last year. While we note that there's obviously been a marked increase in the construction sector, if we look at the relevant category, which is the arts and hospitality sector, which are obviously directly impacted by this decision of the Commission, we've seen a 44% increase in the number of insolvencies recorded from this same time last year. So as noted in the Minister's submission, the very same cost pressures that businesses face, that households face, businesses face as well. There's obviously the impact of cost of borrowing, and our research has said that 1 in 6 WA businesses are being put at risk as their loan repayments now equal or exceed that of their turnover. In addition to the high cost of borrowing, operating costs including fuel, rent, materials, freight, energy and labour have all increased, putting pressure on profit margins. We asked businesses how confident they were going forward, and that confidence sits significantly lower than it did 2 years ago, which arguably could have been the height of uncertainty during the COVID-19 pandemic. Therefore, when considering the state of the economy, we caution against solely relying on those headline figures. It's important to acknowledge that WA is a multi-speed economy, and growth and profitability across sectors is highly differentiated. We also employ the Commission to consider how future economic challenges may disproportionately impact those sectors that are covered by this decision, namely the retail, food and hospitality sectors. So in terms of the future economic conditions, while we don't know what the economic outlook will exactly be, we know that we are an open and trade-dependent economy, and we certainly know that we're not immune to any of the economic uncertainty that exists in the global environment. We also know that our dependence on the mining sector continues to pose a significant risk for our ongoing performance, because it means we're especially vulnerable to price shocks and also changes in demand for our resource sector or resource commodities. We know that aggressive monetary policies to address high inflation will have a contractionary effect on the state's economy. And as Mr. Christmas noted, the state's economy is expected to soften. And in main, that is due to a slowdown in the growth of domestic spending. So we asked businesses how confident they were about performance and conditions going forward. And more than 75% of businesses expect these challenging conditions to continue, if not worsen, over the next 12 months. We also asked businesses about their profit expectations going forward. And 57% of WA businesses expected their profit margins to further decline, and that sentiment is most deeply felt by award-reliant sectors like the hospitality sector. So for CCIWA, our chief concern is for businesses covered by the state system, how they will manage a potential contraction and reduction in consumer spending alongside a potentially steep and substantial increase in the state's minimum wage. We know that significant reductions in discretionary spending will only add to the viability concerns facing non-mining businesses. In our March quarter consumer confidence survey, we asked questions about spending decisions in 2023 and what specifically WA consumers would likely cut to manage their household budgets. So what we found was that almost 65% were planning on reducing their spending on consumer goods like electronics and clothing. 64% were planning on cutting back on takeaways and eating out from cafes and restaurants. And 58% were planning on reducing their spending at bars, clubs and pubs. We also asked questions about how much they planned on reducing their spend in these categories. And on average, households indicated they would cut back most on bars, clubs and pubs by around 18%. So in making this determination, we strongly encourage the Commission to give adequate consideration to these adverse and uncertain economic conditions, because if the economy does contract in that domestic spending space and wages are increased by excessive amounts, this will have a significant hit to businesses and it will have a material increase on the risk of job losses. And particularly for the jobs at the margin, and I mean by margin is the ones that only provide a marginal benefit to the business. I'll now make some comments about the fair system of wages. In the current economic climate, a fair system of wages is one that addresses the needs of the low pay in a fair and appropriate way, but is cognizant of the need to also manage the risks posed by an unsustainable and substantial rise in the minimum wage and award rates of pay on inflation. And this is a key issue. We are concerned that the substantial increase to the state's minimum wage will inadvertently build in further cost of living pressures, as businesses will have no choice but to pass those costs on in the form of higher prices for products and services. And we note in the WALGA's submission that the capacity of local governments, particularly the smaller ones, to bear further costs was also raised, and the potential for increases to the state's minimum wage to be passed on in the form of rate increases or a commensurate reduction in services. We note that one of the reasons WACOS and unions support a 7% increase to the state's minimum wage is the wage price index shows that wages have not kept up with demand, kept up with inflation, and in effect employees' wages are going backwards. We just want to make a couple of points here. The first is in respect to this wage price index, and the latest data, which was released last week, shows that WA now sits at about 4.1% year on year for the March 2023, after rising 1.1% for the quarter. This is the 8th consecutive increase in year-on-year terms for the wage price index and the highest reading since 2012. So if we look at wage growth in WA's private sector, we've seen the highest rate of growth at 4.1%, which is marginally behind the ACT at 4.6%. And this is substantially higher than both New South Wales and Victoria, who've recorded 3.8% and 3.7% respectively. So what that tells us is Western Australian employees are remunerated better than most other states and territories. The second point that I want to make, and it was raised by Mr. Christmas today, and we have brought this up in previous hearings, is that we suggest that the wage price index is an insufficient measure in really understanding wage growth and understates the growth in wages that have been experienced over the last 18 months. We have asked questions to business about their labour costs, including how much base wages have increased and the methods used to attract and retain staff. Of most significance, we found that businesses in industries with high award-reliant employees, notably retail trade, accommodation and food services, have on average increased base wages over 11.3%, which is obviously significantly higher than the WA's CPI of 5.8%. We suggest that especially in this tight labour market, to remain competitive and lift productivity, businesses are looking to find innovative ways to attract, retain and reward their employees, other than just increasing their base rate of pay.
On that basis, Dr. Wesley, one question I had in my mind is that if that subsector of industry are increasing rates of wages to that level to attract and retain labour, and obviously in a very tight labour market you have to do what you can to attract and retain staff, that's the reality. But the impact of that, on those firms of increases in the state minimum wage, which of course can be absorbed into over-reward payments, that raises the issue whether there will be any material impact of a modest increase in the state minimum wage if wages are being raised to that level in accommodation, food services and retail, for example.
And I mean, this
in net terms, there'll be no increase in costs, will there?
Yeah, and that's true. And thank you for raising that point. I think in our view, this information is coming from our surveys, and in terms of those particular sectors, there is a percentage, and it's not obviously across sector. And there's a few businesses that are obviously doing that. It's not
members, of course, who are responding. Is it member only?
No, it isn't. So it's 67% members, and the rest are non-members.
Thank you.
Yeah.
Yes.
So I guess it's a snapshot, but it's not reflective of across the board.
I suppose the point I'm trying to get to is if an assumption is that we're widespread across the industries, for example, hospitality, retail, for the reasons that we've discussed, then the direct impact might be marginal, if any, of a modest, sustainable increase in the state minimum wage. That would have to follow, I think, wouldn't it?
And to be honest, we're supportive of a modest, sustainable increase. It's the substantial increases that we think will put businesses under extreme pressure.
I suppose Dr. Diamond might cavil with what's meant by substantial, but anyway, that's the point I wanted to raise with you.
Okay.
Thank you.
I might just take the opportunity at this time to ask you a couple of questions I've got. Actually, there were 3 in relation to those surveys you were mentioning.
Yeah.
Do we have a copy of the Consumer Confidence Survey? Have you put that in front of us? I know we've been given a copy of the Business Confidence Survey.
We do have a copy here, and that we certainly can provide you. Do you want it now, or...?
Oh, in due course would
Okay.
be fine, thank you. And the other 2 questions I had in relation to the surveys you mentioned were how many participants there were in each? Do you have an idea of?
So on average, it's between 350 and 500 per quarter that we get.
All right. And you mentioned to the
And
Chief
just to
Commissioner-
note that, sorry, Commissioner, it's 1,000 for consumer confidence.
Thank you. You mentioned to the Chief Commissioner that it was 67% members in
Yes.
terms of business. I wondered whether you had any sense of the proportion of businesses that participate that would be in the state system. So whether that's incorporated, unincorporated, do you have any indication?
So at
of
the
that?
back of the business confidence survey, there is a list of participants, and we'll see in the other category is 41%, and that's where those sectors would mostly capture in terms of hospitality and the like.
Are you saying 41% would be covered by the state system?
They're the respondents who fall. So in another category, that in terms of hospitality as an example, would fall in that category.
The category of the state system? Or in hospitality?
No, in that category that we've noted as 41% of the respondents.
I'm afraid I'm not following you. You might take me to it. What I'm wondering is whether it's clear, in which case you might just let me know what the answer is.
Yeah, I'll take it on notice. Yeah.
All right. Well, what proportion of the participants in the Business Confidence Survey are likely to fall in the state
Okay,
system?
we'll take that on notice.
Thank you, Dr. Wesley.
Yes, thank you.
Okay, thank you, Chief Commissioner and Commissioners. Just to follow on that point about wage price index, we know that the use of productivity and performance bonuses, site allowances and sign-on bonuses are measures that are increasingly used, and all these are not officially accounted for in any official reporting. We also know that wage price index does not account for employees moving between jobs, which are then backfilled by employees with less experience but are taking up higher paying roles. I'd just like to turn my attention to the meeting the needs of the low pay and make some comments about that. So in both the unions WA and WACOS's submission, they make comments about Perth's CPI of 5.8% is a material reason why Minimum wage and award rates of pay should be increased, and they make the recommendation of 7%. Just want to note about the CPI. We know that Perth has recorded the lowest quarterly and annual CPI growth in March 2023, with every other major Australian city recording annual CPI growth above 6%. So on that measure, and I've said this before, but Perth is the most affordable place to live. That said, we recognise that households, as businesses are facing increased costs. Now, the Commission has previously recognised that the state minimum wage alone cannot address the needs of the low pay. And as such, the tax and transfers payments have a significant role in providing targeted relief to the low paid. It is therefore appropriate for the Commission in court session today to consider the relevant provisions that have been outlined in the state and federal government budgets, which are aimed at addressing the pressures experienced by the low paid. And I'll just note a few of them. We've got the energy price relief, we've got expansion of parenting payment schemes, cheaper childcare reforms come in from July. There's been a 15% increase into Commonwealth rent assistance. There's a range of housing affordability schemes to make it easier in terms of buying a home, in terms of shared equity schemes in particular. And we know in terms of what Mr. Christmas had noted is there are some homes expected to come online. As I understand it, there's 1,000 social homes will soon enter the market, which will take some of the pressure off WA's rental market. And over the long term, obviously the social and housing investment will see increased supply over the longer term. Now, in WACOS's submission, they highlight the impact of increases in weekly rents on the low paid as one of the drivers for the need of a substantial increase in the state's minimum rate and award rates of pay to make housing more affordable. However, in terms of what we would argue is that this position fails to acknowledge that the key driver of housing, of rental affordability and housing affordability more generally is a supply problem. And that's shown by a substantial decline in the vacancy rates. And an increase in the state's minimum, or a substantial increase to the state's minimum wage, will not address this issue. So government strategies to boost investment in social and affordable housing are necessary, and we note that the federal government and state government have announced a number of measures to address this issue, including, as I mentioned, this dedicated skills migration program to support construction sectors to meet demand in a more timely manner. So in terms of meeting the needs of the low pay, I think the key question is the difference between a percentage versus a flat dollar increase. So taking into account that cost of living increases are regressive and will disproportionately impact those on the lowest incomes, we submit that a flat dollar increase is the most effective manner in addressing the needs of the lower paid. We note that the Minister has recommended a fair and meaningful increase, while unions WA and WACOS are seeking a 7% increase. We also note the Commission's previous concerns about maintaining award relativities, but we suggest in meeting the needs of the lowest sector and the lowest paid, has the greater priority, particularly in the current environment. And so we suggest a flat dollar increase will deliver a proportionately greater benefit to the low paid workers, while at the same time minimising any potential inflationary pressures or added financial stress that face businesses that may occur with a potentially large increase to the state's minimum wage. Just to make some final comments, Chief Commissioner, Senior Commissioners and Commissioners. As noted in my introductory remarks, the Commission finds itself in a really unenviable position in balancing the cost of living pressures of the lowest paid with the cost of doing business pressures that WA businesses, particularly the SMEs, face. In my contribution today, I've sought to outline that despite WA's economic performance, we need to move past that strong headline figures and realise that not all businesses are making exceptional profits in this current environment. In fact, profit margins, particularly for those SMEs, mum and dad businesses, are tight on the back of rising operating costs. So just as households face increasing cost pressures, WA businesses are under increased strain and pressure. Our chief concern then is really how these businesses who are captured under the state system are going to manage the uncertain period going forward, with the potential contraction in domestic spending alongside a potentially significant increase to the state's minimum wage. So we contend that a potentially 7% increase would place further undue stress on businesses, particularly the SMEs, and have a material increase to the risk of job losses and financial viability concerns. We also suggest that it would have an impact on inflation, because businesses are at that point, particularly the SMEs, of having to pass on those costs in the form of higher products and higher pricing for the products and services that they provide. Instead, we suggest the Commission give adequate regard to the suite of measures that exist in terms of addressing cost of living pressures when making its determination. We also contend that the flat dollar increase is the most effective way to deliver a fair and appropriate increase, because it targets those of the lowest paid who are arguably disproportionately impacted the most by these cost of living pressures. So thank you. That concludes my presentation.
I just have a short question. You talked about the cost pressures on business, the costs of borrowing, fuel, rent and labour. And I think you referred to that also at paragraph 37 of the written submissions. Do we have anything before us that demonstrates increasing costs to business of rental costs in particular, or any of those other costs?
I might just refer that question. This is Sam Collins, who is our senior economist, and he is responsible for the business confidence
Thank
survey.
you, Mr. Collins. Is there anything that you can point us to that demonstrates those increased costs to business?
So nothing headline percentage number in particular in terms of how much they've increased. What we can look at is on the front page of our business confidence survey, one of the questions we ask is a barrier to growing your business over the next 12 months. And we talk about rising operating costs as a whole. When we talk about rising costs in this survey, we generally refer to operating costs as a whole. So that will not only include labour costs, but also in terms of materials and other goods and things like that. So in that survey, we considered about 80% of businesses have found rising operating costs themselves will be a barrier to growing their business over the next year. In terms of the actual increase that they're facing from that increase, we don't have a number in that sense, but in terms of the proportion of businesses facing an increase, we do, which is there.
Thank you.
Yes, just had a question about, you referred to profitability and sourcing that in the business, I think in the business confidence survey. Could you just point me to where that is in the survey, in the report that you provided?
I'll refer again to Sam Collins too.
Okay, thank you.
In paragraph 4 on the front covered page, there's a reference to the 56% in terms of the profitability margin. In terms of the actual profit index itself, that was included in the submission initially, not necessarily in this exact survey here, but it will be in the submission. I can get back to you on where exactly that is. That helps.
Well, I'm interested in what the source of the data is then.
So the source of the data for the profitability index comes from the responses from our survey.
Okay,
Yep.
So
that's straight from the businesses themselves.
right. So is it right then that my understanding that you'll do the survey, you do the report, but not everything's reported in the report?
No, so we do everything, but we choose what is included in the report. So we have the same data each survey we have available to us, which is what we've actually referred to in some of the submission. Doesn't mean we'll necessarily include it in each survey, but we do have that data on hand.
Right, okay. Right, thank you.
Thank you very much, Dr. Weasley and Mr. Collins, for your assistance.
Thank you, Chief.
Given the time, Dr. Diamond, it's now 5 to 1, we might take a break and resume after lunch at 2:15. We'll stand adjourned till then. Thank you.
We stand adjourned.